Okay, so our stopping point on our last video lecture was showing how a premium will be amortized over the life of the bond. So as the premium is being reduced, amortized, the carrying value in this case is going to decrease so that by the time that bond matures, that the carrying value will be the same as the bond's face value amount. So whether you have a discount or a premium, they both have to be amortized over the actual life of the bond. If a bond is issued at a premium, the interest expense is going to be less than the interest payable. If a bond is issued at a discount, the expense is going to be higher than the interest payable. Okay? So hopefully you understand those concepts. I want to go back because I skipped a section on, to get to that, on a bond being redeemed and what does that mean when a bond has been redeemed. Okay? So redemption means that a bond is now being bought back by the bond issuer. So they issued a bond and now the bond has matured. So now they must pay back the amount that's owed to the actual bondholder. When a bond is redeemed, you would debit bonds payable for its face value amount, and you're going to credit your cash account. Because remember that whether a bond was issued at a discount or at a premium, when that bond matures, its carrying value will be the same as the bond's face value. So again, you would debit bonds payable and credit cash for the bond's face value amount of $100,000. Now, if a bond is callable, a bond can be redeemed before its maturity date. Again, if a bond is callable, a bond can be mature before its maturity date. That means a bond can be paid back early. We have to take a look at what was the bond's carrying value at the time it was redeemed, and what was the amount that we paid to redeem the actual bond. So if the amount paid was more than the bond's carrying value, we'll recognize the loss. If the amount paid was less than the carrying value, we'll recognize a gain. If those two amounts are the same, then there's no gain and there's no loss. So when a bond is mature early, redeemed early, there could be a gain on redemption. There could be a loss on redemption. It's contingent upon the amount of cash we have to pay in order to redeem the bond and the bond's carrying value at that particular point in time. For example, assume at the end of the fourth period, in a 4-year, Candlestick, having sold its bond at a premium, when they sold for 102, retires the bond at 103 after paying the annual interest. This means we're going to pay 103% of the bond's face value in order to retire these bonds. So again, when it says 103, that means we're paying 103% of the bond's face value in order to retire these bonds. At the time the bonds are retired early, they have a carrying value of $100,040. Remember that the premium was $2,000, amortized over 5 years or $400 a year. We've already amortized it over 4 years. So right now we're saying that the bonds have a value of $100,400. Now, what does that mean? That means that the bonds have a value of $100,400, but in order to retire these bonds, we paid an amount at 103. So we paid 103% of the bond's face value in order to retire them. So multiply 100,000 times 1.03, use my calculator. We paid 103,000 in order to retire this bond early, although they only had a carrying value of $100,400. So we'll debit the bond's payable account for $100,000. That's the bond's face value. The premium on bonds payable will debit for $400 in order to amortize the remaining premium. We're going to recognize a loss on bond redemption for $2,600. That's because the bonds have a carrying value of $100,400, but in order to retire them, we paid $103,000. Therefore, the difference between these two amounts gives us a loss on bond redemption in the amount of $2,600. So when a bond is redeemed before maturity, we could have a gain or a loss depending upon the bond's carrying value at the time of redemption and compare it to the actual amount we're going to pay to redeem those bonds. Okay? Another example. We issue 500,000 10-year bonds at a discount. Prior to maturity, when the carrying value of the bond is $496, so the carrying value is $496, the company redeems the bonds at 98, which means 98% of the bond's face value. All right? So, if you take $500,000, use my calculator again, multiply that times 0.98, that gives you $490,000. It's the amount that we paid to redeem the bonds. But their carrying value was actually $496,000. Therefore, we're going to have a gain because we paid less than the bond's carrying value in order to redeem them. So, the journal entry, you'll debit bonds payable at its face value of $500,000. You're going to credit the cash account for $490. We need to amortize remaining discount on bonds payable of $4,000. Remember, the carrying value was $496 at the time, so the remaining discount was $4,000. And recognize a gain on bond redemption in the amount of $6,000. So again, if the amount of cash paid is less than the bond's carrying value, we're going to recognize a gain for the difference. Okay? Next up, we look at how to analyze the liability reported on the balance sheet. So on a classified balance sheet, we're going to separate our current liabilities from our long-term liabilities. Okay? That's important because from an analyst standpoint, we're going to prepare a different type of ratio that focuses on what we call solvency compared to liquidity. Same thing with our assets. We're going to separate our current assets from our non-current or long-term assets, separate our current liabilities from our non-current or long-term liabilities. That allows us to do ratios that focus on things such as liquidity. Liquidity focuses on our ability to take care of our short-term obligations as those short-term obligations become due. So we're comparing our current assets against our current liabilities. We have what's known as the current ratio, which focuses on current assets compared to our current liabilities. And I show you the formula. So I'll tell you, so the formula is current assets divided by your current liabilities. So we want to know, do we have enough in current assets to take care of all of our current liabilities? So we look at General Motors in 2013, the ratio was 1.31 to 1. How is that interpreted? I'm glad you asked that question. It means for every dollar we have in current liabilities, we have in current assets $1.31. meaning that we have sufficient current assets to take care of our current liabilities. We are very liquid. Now, the ratio went down slightly in 2014 to 1.27, but even then, our ratio is still better than our industry as a whole. So they're saying General Motors does have the ability to take care of their current obligations as those obligations become due. Now, the next ratio focuses on solvency. We're now looking at long term. We're saying over the long term period, are we able to take care of our obligations as they become due? So for this ratio, for debt to asset ratio, you're comparing total liabilities against your total assets. Again, comparing total liabilities against your total assets. We want to figure out what percentage of our assets were acquired through debt. All right. So look at General Motors again. In 2013, the debt to asset ratio was 74%. It means 74% of their assets were acquired through debt. So they have a lot of debt in General Motors. And that ratio only got worse in 2014. It increased to 80%. Compared to their industry, being the auto industry, on average, the ratio will be about 62%. So General Motors has a high use of liabilities in order to acquire assets. Now, you don't want to be too dependent upon debt, because in this situation, if we keep relying upon debt solely, then once that debt has been repaid, we may not have the ability to stay solvent. And once a company becomes insolvent, it means they do not have the ability to take care of their obligations as they become due. And insolvency is followed by bankruptcy. So these ratios are very important to see if we can take care of our current obligations as they become due, and our obligations on a long-term basis by looking at our debt to asset ratio. Okay? Contingencies. What are contingencies? These are liabilities, or what we call potential or pending liabilities. It means a liability could take place depending upon the outcomes, which are going to be uncertain. Let's say there's a lawsuit that has been filed against your company. Depending upon the outcome of that lawsuit, you could have a potential liability. Product warranties. When a product has a warranty saying that if a product breaks down, we will repair or replace that product, you could have, a potential liability depending upon the outcome. So when it comes to the contingencies, the accounting rule says that we must disclose them in our notes. We must talk about any potential contingencies there are. We must also try to indicate the probability of the outcome coming to existence. And if we can estimate the amount of the liability we may have to pay based upon the outcome of those liabilities. Okay? So we've already covered the amortizing of bond discounts and bond premium. And that will conclude our Chapter 10 lecture. So that section on bonds can be challenging. So once again, take your time, go back, review the information, understand how bonds are issued at their face value, discount, or premium. Understand how to amortize a bond premium or how to amortize a bond discount. Okay? Bye-bye.